Well, good morning. My name is Patrick Woodcock. I'm the President and CEO of the Maine State Chamber of Commerce. So glad you could join us today to get beyond the headlines about the big, beautiful bill, which is one of the more consequential economic pieces of legislation in decades. We probably are familiar with a lot of the components. However, there are provisions dealing with childcare, dealing with deductions, research and development, that really every business should be aware of so that Maine's business community fully takes advantage of these provisions. This is both at the corporate level and the individual taxpayer level. So pleased to have our experts today to give some context of this legislation. As the Maine State Chamber of Commerce wrote our congressional delegation, it is imperative that we look through the prism of economic growth as the Maine economy faces challenges with projections of limited employment growth in 26 and 27. The key provisions that we'll be outlining today, we certainly think have the ability to maintain economic growth for the United States and the Maine economy. We outlined to the congressional delegation in June key provisions that we thought were imperative to be maintained. As we articulated in the letter, the Maine business community fully supports maintaining the corporate tax rate at 21%, reinstating immediate expensing for research and development, permanently extending the provision that allows full expensing of depreciation, and allowing the 20% pass-through deduction, as well as retaining existing income tax rates. Now, it's been clear that the legislation also presents challenges, especially for rural healthcare delivery, which have already been fragile. It's the Maine State Chamber's intention that we'll be examining the future of healthcare and delivery post Big Beautiful Bill and opportunities with the Rural Healthcare Transformation Fund that Governor Mills announced last week that she'll be pursuing for an application in November. Very quickly, I did want to go through our attendees today. We're very pleased to have Neil Bradley, who is the Executive Vice President, Chief Policy Officer, and Head of Strategic Advocacy at the U.S. Chamber of Commerce. We have John Hodwin, who is the CPA and is a tax principal at Alvin, Randall, and Bennett. Jim Rogers is the President and CEO of several information technology service companies. ProInfonet, which he founded in 1995, provides nationwide IT consulting. And Geoff Baur, who is Vice President of IDEXX Laboratories and a board member of the Maine State Chamber of Commerce. With that, we are going to have an opportunity for questions at the end of the presentations. But with that, I wanted to turn to Neil Bradley for an overview of this critical legislation. Neil? Oh, Neil, I think you're on mute.
Yep. Well, yeah, it's first thing Monday morning, so we have to start on mute. Patrick, thanks so much for pulling us all together and helping us walk through and dispel, I think, some of the myths around this bill. Let me start with the title. Technically, in the law, this is the title of the bill, the One Big Beautiful Bill. I'm not exactly sure that would be the title I would choose if I were a member of Congress and trying to describe this, but nevertheless, that's the legal term. What's important to us at the U.S. Chamber, and I suspect what's important to all of those who are gathered here today, is not so much what we call the bill, but what it does for economic growth and for businesses across Maine and across this country. And so I want to walk through just kind of a few of the key aspects of this. And if we just go to the next slide here, if you leave with nothing else today, these are kind of the three key takeaways. First, this bill ensures tax certainty for businesses. We'll get into a little bit of what that means in a moment. Second, this bill supports the type of investments that will allow businesses in Maine to expand, to grow, to modernize, and importantly, to help add employees. And three, it has specific provisions designed to help employers support their employees. And so we'll quickly walk through all three of these, and I know some of my co-panelists will dive into some of the particulars with even more detail. So let's go to the next slide. Perhaps the most important thing it's actually not on this slide, but the most important thing to remember is what would have happened had this bill not become law, had Congress not passed anything. Well, what would have happened is at the stroke of midnight on December 31st of this year, we would have had a $4 trillion tax increase that automatically would have gone into effect. And so if you are, for example, a pass-through business, and by the way, 55% of private sector employees in Maine work for a pass-through business. We would have seen the top tax rate on those employers go up by more than a third. We would have had nearly $1 billion a year tax increase on approximately 104,000 businesses in Maine. So had Congress done nothing, the real impact on Main streets across the country, and particularly there in Maine, really would have been devastating. It would have taken the top marginal tax rate for the business income for these pass-through businesses from around 29% and put it over 39%. It is a massive tax increase, and it would have had a devastating impact. I suspect it would have pushed us into a recession, but for Congress passing this bill. Importantly, we would have also had automatic tax increases on individuals and multinational companies. So businesses, including some of those located in Maine who do business abroad, automatic tax increases. Now, all of those provisions, the provisions for individuals that were enacted in 2017, the provisions for pass-through businesses, the provisions that impact global companies, those are all made permanent. No more tax cliffs, no more threats of automatic tax increases that would have such broad, widespread impact. That certainty is particularly good for businesses who are looking to invest, which actually leads us to the second aspect of what we think is important at the U.S. Chamber. If we go to the next slide, and that's support for investments. You know, when businesses are growing, one of the things they have to do is they have to expand their capacity. And so if you're in manufacturing, for example, or in construction, that means not just new people, it means new equipment. If you're in an office setting, new headcounts means new computers, new office furniture, all the things that a business needs to be able to grow. One of the most important things that the federal tax code does for economic growth is decide how it treats these type of capital investments. Do we allow you to deduct 100% of the cost of that investment in the year that you make it? Or do we make you deduct portions of it over 5, 7, 9, 11, and sometimes even longer number of years? You all recognize the time value of money. If you get to deduct all the cost of an investment that you make in your business this year, that's much better for the after-tax cost of the investment than if you have to spread that out over the next 9 years. And so bonus depreciation, or what is sometimes referred to as expensing, means that businesses right now can be making the investments that they need to grow. Importantly, what the bill did was make this retroactive to any investments that a business has made from January 19th of this year on, and this is permanent. If you happen to be a small business, think gross revenue of around 31 million or less, then we even have a more simplified way for you to expense the investments that you make in your business. It's called Section 179, been around for a long time, but it used to be limited to about $1 million of investment in your business. That's been increased to $2.5 million permanently under this bill, which means it's just even easier for small businesses to get this tax benefit of investing in their businesses. There's actually a new provision. This one will be in existence for 4 years that has to do with facilities. So normally if you're building a facility, it could be a warehouse, it could be an office building, restaurant, manufacturing facility. You deduct the investment that you make in that over around 39 years. There's slightly different rules for different aspects, but in general, think of it this way. You're deducting the expense essentially over 4 decades. If you are making an investment in qualified production facilities, so think about manufacturing, production, refining facilities, you get to expense in year one 100% of the investment that you're making on that for construction that occurs before 2029. And then perhaps importantly for businesses, and I know we're going to talk about this more, who are investing in research and development. There was a period between 2017 and now where we were forcing companies to amortize their R&D expenses. So both the personnel costs and the investments they were making and doing research and development for their businesses. We've now fixed that, and companies can deduct the investments that they're making in research and development immediately. And importantly, if you happen to be one of those small businesses, gross receipts of 31 million or less, you can today go back and amend your tax returns. Talk to your tax accountant because it's more complicated than I'm making it sound. But you can essentially go back and amend your prior tax returns to get the full benefit that you were denied over the next several years. I'll just flag one thing, and as we're talking to business leaders around the country, when the federal government makes a change in its tax code, that can often have implications for state tax codes. And so states often mirror the same type of thresholds and definitions that exist in federal law for state tax purposes. In some states, they just automatically conform. When there's a federal tax change, the state makes an adjustment. Maine, you have a system in which your legislature will have to get together and they will have to make changes and decide whether or not to conform to what's been done at the federal level. Obviously, for businesses, for employers in Maine to get the full benefit, you want to conform to bonus depreciation and R&D expensing so that you can get the full benefit and not have some of it taken away by the states. Let's go to the next slide, please. And that's help with the workforce. This is perhaps 3 provisions that I've seen almost talked about nowhere that I really think can help employers and families. Perhaps the most important is an enhanced employer provided child care credit. So in the past, the federal government has said, if you're a business and you create an on-site child care, we'll help you by giving you a tax credit towards the cost of that. Of course, most businesses aren't big enough to justify an on-site child care facility. And so if you're most businesses in Maine, this tax provision really didn't do much for you. Congress has, in this one big beautiful bill, adjusted it. One, it's increased the child tax credit if you have 31 million or less in gross receipts. It's now 50% of your expenses in the form of a tax credit, up to $600,000. But most importantly, you can get together with other businesses in your community. You can now contract with a child care provider, for example, to get more slots for your employees at that child care facility, or to get preference on a wait list, or to expand eligible hours to match up your business. You can partner and do all of those things, and you and the other employers in your community that you partner with can all take advantage of this tax credit. So this is a really great way for businesses in local communities to figure out how they address jointly, collectively, the lack of childcare resources that exist in most communities and obviously impact a lot of the workforce. Second, let's assume you're employing a lot of college grads. One of the most important things you can do is help them pay off their student loans. And now you can provide up to $5,250 in student loan payments as an employer for your employee, and that doesn't count as income for the employee. And so that's a really great way of providing an added benefit that doesn't incur tax consequences. And finally, if you happen to be an employer that's providing family and medical leave. So you have an employee, they qualify for FMLA, which of course under federal law is uncompensated, but you're providing a benefit, you have the ability to get a tax credit to help offset some of that cost. And so in the past, this was really hard for employers to access. It's been made easier under this bill, but it's something to think about if you're an employer who does that. Last slide, and I'll just end on this. There are a few other things that kind of kick around that people talk about. I think they're perhaps the first two are maybe less important for the employer community, but a good thing to know. No tax on tips up to $25,000 begins to phase out at 150,000 in income. That'll expire after 4 years. No tax on overtime. Up to 12,500 for an individual, 25,000 joint, also phases out at over 150 or 300,000 in joint income. Again, that'll also sunset. And as Patrick mentioned, there is this $50 billion fund. Your senator was key in getting this into the legislation that we believe is going to help offset some of what you've heard about the changes and the impact on financing for hospitals, in particular rural hospitals. And that's something that I know the Maine Chamber's engaged in. We're engaged in at the U.S. Chamber to make sure that we get all the benefits of this bill for businesses on Main Street, for multinational employers, for workers, and at the same time, figure out how to address some of the shortcomings with respect to rural health and Medicaid. So with that, I'll turn it back over to Patrick, and we'll continue with the program.
Well, thank you so much for that description, Neil. There's clearly a lot of components here that businesses uh, can utilize to address what are our biggest challenges: childcare, student loans, and also pool together resources with childcare, which is an interesting model for regional economies that we have throughout the state. Um, I did want to turn now to John. John's going to do a description of the individual tax levels, and then we'll get a roundtable for discussion with some of the businesses in Maine. But I'll turn to John for a discussion on the individual side. John?
Thank you, Patrick. Good morning, everyone. So I also want to talk about the pass-through entity tax as well, and we'll kind of dive into that in the middle part of this presentation as we talk about the state and local tax limitation that was modified. Next slide. So we're going to talk about a lot of the individual provisions and really some things that you should start thinking about now versus, towards, the last couple months at the end of the year or even after the year, because now's the time to take advantage of it. Now's the time to plan and take advantage of it. Really tough to do good tax planning if you're being reactive. So start, working with your tax advisor now to see if you can amend returns for the R&D or take advantage of, charitable planning or accelerated expensing. So, I'll start off by saying, work with your tax advisor sooner, rather than later. Neil did a great job, explaining, how OB3, I refer to it a little bit easier to say, as opposed to the one big beautiful bill. It extends, all of the individual provisions and makes them, permanent because they were going to sunset at the end of the year. Next slide. So as Neil mentioned, rates were going to go up. Top rate was scheduled to go up to 39.6. Now it's going to be 37%. There are no changes to the capital gains rates. We currently have the 0%, the 15%, and the 20%, capital gains rates that we've had over the past several years. So the next several slides are kind of highlight the changes in rates of, what we have currently and what would have been if OB3 had not been passed. Next couple slides. Next slide. With OB3, we're going to continue to have a increased standard deduction, which many individuals have continued to benefit from. Next slide. As well as the repeal of personal exemptions. And that's really tied into the standard deduction and that increased level right there. And so those are permanently terminated, except for the senior deduction, which we'll talk about in a little bit. Next slide. We also have an increased child tax credit, was 2,000 goes up to 2,200, and it's going to be indexed for inflation. Next slide. Some other provisions that are extended. Big key one that we've been monitoring for the last couple of years is the estate and gift tax exemption that was scheduled to be repealed and go down to around 7.5 million. Now it's permanently extended and indexed for inflation. It's going to be 15 million per taxpayer. So for a married couple, you're talking about 13 million. So some well-needed relief and some good tax certainty for going forward. We also have increased AMT exemptions with the modified phase-outs, which have been very beneficial for taxpayers in Maine. Prior to TCJA, a lot of clients I worked with were subject to AMT, which is a separate tax computation, and they were having to pay additional taxes in addition outside of regular income taxes. OB3 extends the limitation for a mortgage interest, which means that any interest that you pay above the principal balance of $750,000 will be non-deductible. It also terminates the miscellaneous itemized deductions or the 2% miscellaneous itemized deductions, such as the financial advisor fee, tax preparer fee, employee, business expenses. Those are repealed as well. Next slide. So one of the biggest, changes evolves around, itemized deductions and kind of the various limitations that they put into place. And the first one that we'll talk about here is the 0.5% floor on charitable contributions. And what this means is for charitable contributions to be deductible, they're going to have to exceed 0.5% of your adjusted gross income. So if you have 100,000 of tax or adjusted gross income, for any charitable contributions to be potentially deductible, it would have to exceed $500. And so this provision comes into play for the 2026 tax year. So I've been working with a lot of my clients about, giving now in 2025 versus 2026 because the value of the charitable donation isn't going to be as great. And so one of the tools that we've been utilizing is utilizing a donor advised fund to kind of pre-fund 2, 3, 4, 5 years of donations that they want to make. And whether they use cash or they use appreciated securities, it's been a very powerful tool along with the itemized deductions limitations that I'll talk about in a few slides. Next slide. There's also provision limiting gambling losses. Typically, they were 100%. Now with this provision, they're going to be 90% of winnings. Next slide. Now we're going to stay with the SALT limitation because this will kind of dive into the pass-through entity tax that we talked about that will benefit Maine small businesses. And this has been a, I wouldn't say controversial, but very hot topic. So what the SALT limitation is a limitation on all the taxes, income taxes, real estate taxes, excise taxes that an individual or a trust can deduct on their return as far as itemized deduction. If you have trade or business taxes, you have a rental property, or you have a Schedule C, you can still deduct those taxes. But these are personal taxes that are subject to this limitation. If you own a flow-through entity, a partnership, an S Corp, the income reported on your return, those state taxes are subject to this limitation as well. And so with OB3, we have an increase in the 10,000 limitation to 40,000. But there's a little caveat here. There's a phase out of it. If your adjusted gross income is 500,000, there's a phase out of it up until 600,000 of taxable income. So you may or may not get the full 40,000 depending on where your income lies. And then it's going to be, indexed for inflation over the next several years. And back in 2030, it's going to go back to 10,000. Next slide. And then next slide. So here's where the pass-through entity tax comes into play. And a lot of states have been doing this since the Tax Cuts and Jobs Act was enacted. And this is a tax that partnerships and S corps can do, where it pays the state income tax directly on behalf of the owners of the entity. This reduces the federal taxable income that's passed through to the owners, so the owners pay less federal income taxes. The owners will receive, a state credit, so they're not double taxed on that income at the state level. Next slide. So, I mean, this is necessarily to help small business owners of the state of Maine avoid this SALT limitation. And we've been working hard. I say we, but I'm a part of the Manufacturers Association, and they've put forth a couple pass-through entity tax bills, LD 1892, and then last year LD 191, to try and get a pass-through entity tax into the state of Maine. And this is a really powerful tool that can put money back in small business owners, pockets, by reducing their federal, tax burden by bypassing this SALT limitation. Even with an increase in that 40,000, SALT, deduction, a lot of businesses are still going to be able to utilize it. And if you think about it, if you're able to utilize it, it could help with that 0.5%, charitable floor that's going to come into play next year. So this pass-through entity tax can help with other tax matters as well. It's also not applicable to the alternative minimum tax, can help taxpayers with that. And it also helps reduce self-employment tax. Self-employment tax is a 15.3% additional tax on a self-employed individual's first 172,000 of net profits on it. So that can be a pretty powerful tool if the state of Maine were to implement this. Next slide. So this is something that, the state does need to take action on, and LD 191 has been carried over to this next session, something that has been worked on for a couple of years. And Maine is one of 6 states that has not passed this. So it's very important, and hopefully, this gauges your intention. You can reach out to your local representative and learn more about this, because it can be a very powerful tool in helping putting money back into your business. And so next slide, I won't go through, but this is just an example of, the tax savings off 100,000 of taxable income. So, and then the way that this was designed, and like a lot of states designed, is they were able to kind of share in the federal tax savings as well. So it's really a win-win for the state. It generates a little bit of revenue, but also small business owners save in overall federal taxes as well. So it's a good example to go through the mechanics of how a pass-through entity tax works and how it could impact your business. Next slide. As I mentioned earlier, there's a limitation on itemized deductions if you're in the 37% tax bracket. So if your income is north of 751,600, married filing joint, itemized deductions are going to be, limited. And the simple computation is it's going to be limited by 2/37 to really kind of put, the benefit of any of those deductions to like a 35%. So it's really a 5.4% kind of haircut on those deductions. And this is really just meant to be like a revenue raiser as part of the bill, because there are a lot of spending components of it. So again, if you're in the the top income earners, best to kind of bunch as much itemized deductions as you can into 2025, just so you're not hit with this, because this limitation goes into effect in 2026. Next slide. Next slide. And for those that don't itemize, they can take a partial charitable contribution, which is an above the line deduction. Important to distinguish between an above the line deduction and an itemized deduction, because everyone can take an above the line deduction. We'll be talking about the senior deduction, the no tax on tips, car interest. Those are all above the line deductions, which means you can benefit from this even though you don't itemize. And so this will go into play for 2026. Important to note on this is these donations have to be made with cash. They can't be non-cash contributions. Next slide. The senior deduction goes into play for 2025. And this was really kind of morphed into the no tax on Social Security. No tax on Social Security didn't make it into OB3. It turned into the senior deduction, which is a $6,000 deduction per senior. Seniors defined as being 65 before the end of the taxable year. And there's phase outs associated with it, starting if you're married filing joint, adjusted gross income is $150,000. Next slide. Heard about the no tax on tips. It's effective for 2025. There's phase outs associated with it. Guidance keeps coming out. Just last week, they had a revenue, an IRS notice classifying what industries do qualify for the deduction, so that you have individuals not qualifying for it as well. Next slide. Now we have no tax on overtime, another provision of OB3. Next slide. And then we have car loan interest, another above the line deduction that's effective for this year. So a lot of changes going into effect. So, IRS is currently updating their forms. Hopefully we don't have a delay in filing season. Could make my life a little stressful come April 15th. So hopefully they're able to update the forms and we can start this. But this is an amount equal to $10,000. There's phase-ins, starting with when your income for a married joint filer, $200,000. But with this, there's kind of restrictions around it. It has to be a new vehicle, can't be a used vehicle. The gross weight has to be less than 14,000 pounds, and the final assembly has to be within the United States. So it could be challenging to qualify for it. Next slide. Already talked about the 199A, the 20% or the QBI deduction. But another thing I do want to point out is they established a minimum deduction of $400 if you're active in the trade or business, which can be beneficial. Next slide. I'm not going to go into this, but Trump accounts are similar to 529 accounts. But I will make a note that if you have any children or grandchildren born in 2025, pay attention to this, because they're entitled to a $1,000 deposit from the federal government. So go back to these slides afterwards and kind of review these. They're kind of like a 529/IRA kind of put into one. So you can skip the next couple slides. So QSBS is qualified small business stock, and this is for taxpayers that operate in a C Corp. Typically, you don't want to operate in a C Corp because, CPAs kind of dread the term double taxation. It raises your effective rate to over 50%. But if you're, a qualifying corporation and you're in the right industry and you qualify for this, this can be a very, very powerful tool, where you get to exclude the capital gain on the sale of stock. And what they did with this provision is they created a tiered structure to it. Instead of having a 5-year 100% exclusion, they kind of phased it in, where if it's 3 years, you get a 50% exclusion. 4 years, you get a 75% exclusion. And they also increased that $10 million exclusion to $15 million. So quick example right here. So if I sold my company for, 10 million and I held the stock for 5 years, I could exclude that entire $10 million from taxable income. federal and state purposes. So it can be a very powerful tool. But again, you have to make sure that you're operating in the right industry and make sure that it's the right entity structure for you. So there's a little bit of risk associated with it, but but it could pay out at the end. Next slide. So I'll wrap up here with some other kind of changes to think about come, tax planning or going into next year. The energy efficient home improvement credit, that's going to expire at the end of this year. That's if you install heat pumps or insulation doors on your home, no longer available starting 2026, so final year. Opportunity zones, which can be a very powerful tool when you sell a business or you have capital gains. You can invest that capital gain into a qualifying fund and be able to defer, capital gains for, 5-7 years until a certain date, and then you have to pay taxes on it. But really, the benefit is, that second investment that you put that capital gain into, if you hold it 10 years and that appreciates, and you hold it 10 years and a day, you sell it, that gain can become tax-free. So they've extended that, and they're going to redraw the zones effective next year. So something to keep in mind when you sell a business or you have significant capital gains and you're looking to defer those as well. For 2026, they've increased the 1099 threshold to $2,000. And then starting at the end of the month, the IRS Treasury would like to have you make payments electronically. So if it's something that you're not doing now, whether you're an individual or a trust or a business, you should start to make this transition now. There's an executive order that came out in March requiring Treasury to stop issuing checks and accepting checks. And then, as Neil mentioned, a lot of this, items I talked about are federal provisions. We don't know where states are going to end up, based off of, federal, IRS conformity. So we need to have Maine kind of conform to this. Are they going to tax tips? Are they going to tax overtime? We still need to wait and see on that. So I'll turn it back to you, Patrick.
Thank you, John. I do want to turn to two main businesses, small one and one of our largest employers, to talk about the implications for them. I do want to use this as an opportunity to highlight the importance of tax conformity. As John noted, that is ensuring that businesses can have a seamless filing season, but also to take full advantage. We do think there are some clear opportunities for modifications. The pass-through entity tax, where the Maine State Chamber, Maine Manufacturing, Ski Maine Association, Retail Association have all come together to join those 36 states and allow businesses to lower their federal tax liability that 36 other states have done. We think that there is clear need for that, given the certainty in the SALT provisions that were enacted in the Big Beautiful Bill. I did want to turn to Jim now to start us. Jim has been really highlighting the concerns of the existing tax law on his business, and specifically with research and development deductions. But Jim, I wanted to turn to you for an assessment of what the legislation has meant and implications for your business.
Thank you so much, Patrick. I really appreciate being invited onto this panel. I'm going to talk about 4 areas. If you can go to the next slide. Section 174, Section 199A, the Section 179 depreciation, and maybe a little bit on SALT, although that's been covered already. So we talk about small business, and I have a tech company here in Maine, based out of Bangor, Maine, 30 employees. The federal definition of a small business is actually any business that has less than 500 employees. So that's a lot of companies in Maine that are 500 or less. So I'm pretty small with 30. And yet there are 4 things that in Big Beautiful Bill that really were huge benefits and I'll talk a little bit about that. I'll start with Section 174. So Section 174 is about research and development, also called Qualified Research Expense, QRE. So some people talk about R&D or QRE. They really mean the same thing. And it's tax law went into effect in the Tax Cut Jobs Act, TCJA, that passed in 2017. That was what overturned 70 years of how R&D, research and development expenses were treated. So just a little bit of background on TCJA. It forced companies to amortize their research and development expenses over 5 for domestic or 15 years for foreign. What that did is it created phantom profits and surprise tax bills. How did it do that? Well, it took the dollars that were paid out, the expenses in research and development, and that got added back in as profits, and then that got taxed. There's an estimate that over 500,000 workers in 2022 and 2023 were laid off because of the changes in the research and development laws from the Tax Cut Jobs Act, TCJA. So 70 years of how R&D was treated was overturned with TCJA. So Big Beautiful Bill fixed that. I'll give you my personal example. This bad legislation from TCJA went into effect starting in 2022. So I was required to add a third of my payroll spend, which was classified as R&D spend, back into income, which was then taxed. This resulted in an actual tax rate for my small business, which is a pass-through, of 102% federal plus state. When you actually look at our real profits, we were taxed 102% of that. It was crippling, really hard on small businesses throughout the country, especially here in Maine. The Big Beautiful Bill change will get rid of that, and the money that is classified as research and development, my payroll expense, I no longer have to add that back in as phantom profits. What about Maine businesses as a whole? So back to TCJA, Maine's R&D spending in 2021, the year before the TCJA change went into effect, was $870 million a year. That was between industry, higher ed, and nonprofit. The research and development by just businesses in Maine is estimated to be between $500 million and $600 million a year. So it's pretty impressive for for the small businesses here in Maine. Due to the Tax Cut Jobs Act, in 2022, 90% of that spend, that 500 to 600 million, became taxed, and that resulted in small businesses paying somewhere between $125 million and $150 million in extra taxes because of that phantom profit. So it was really, really crippling, and I feel very happy that for small businesses such as mine, the Big Beautiful Bill fixed that, so we no longer have to do that. All right, moving on to Section 199, the next slide. So qualified business income, or Section 179, and John and Neil both spoke about this a little bit. That's the 20% tax deduction that a pass-through company can take, an S corp or partnership or LLC or sole proprietorship can take that extra 20%. Again, I'm going to just tell you what it was like before the Big Beautiful Bill. The 20% was actually established by Tax Cut Jobs Act in 2017. That deduction was going to expire this year, and that would leave small businesses uncertain about future tax bills. So that 20%, the reason it's really important is because large corporations, or C corporations, their tax rate went to 21% as a result of TCJA back in 2017. So the 20% Section 199 tax break for qualified business income for small businesses or pass-throughs, that was really to help bring parity between small business in the country and large business whose tax rates went to 21%. So impact on small business here in Maine, The U.S. Small Business Administration estimates that there are 151,000 small businesses in Maine, businesses that have less than 500 employees. And I just came up with some examples. If just half of those small businesses generated $80,000 a year in qualifying business income, just half of them in this example, then this new law, the Big Beautiful Bill law, would save those companies $240 million a year in extra taxes. So it's really, really powerful. All right, moving to the next slide, going on to Section 179, depreciation or bonus depreciation. That's been around. My company's 30 years old, and Section 179 has been around for as long as I've been in business. It used to be a very, very small amount where you could, any capital expense, you could immediately expense or deduct that in the year you spent the money. But what Big Beautiful Bill was, it increased that Section 179 expense of capital purchases up to $2.5 million. Really, really significant, because now a small business can spend up to $2.5 million. There are some phase outs up at 4 million, but and this also indexed for inflation. So that's capital equipment, software, etc., that you spend money on, and you can expense it immediately rather than having to amortize it. So really, really powerful, and that is really also going to help. It encourages investment in equipment, farms, boatyards, manufacturers, etc. So that is a good one. And then SALT, the last slide, that's been covered. Go to the next slide. Thank you. I put a lot of content on my slides, but also helpful for pass-throughs, raising the SALT cap for 40,000. It's been really hard. That was the Tax Cut Jobs Act in 2017 put this limit into effect back to 10,000. That means that when a small business or a pass-through pays state taxes, they also have to pay federal income tax on the state taxes that they spent. So it's really, really a disadvantage. While that rate that was raised in Big Beautiful Bill to 40,000, unfortunately, because Maine does not have the pass-through entity tax workaround, then that's still crippling and really hard on small business. So I'm very hopeful that Maine will be able to figure out how to get that pass-through entity tax workaround. One of 6 states in the country that didn't pass that, so that'd be really, really important to do. So that's kind of a brief update. I'm going to pass it over to Geoff, who will talk about some of the same things from a larger business perspective.
Thanks, Jim. One of the things that I would thank you for is you've been a real advocate of highlighting these issues through the chamber and through others directly to our legislators. And I think that you are a big part of raising awareness of this in something that affects all of us. So, I thank you for that.
Thanks, Geoff.
I'd also, I'd like to, rather than go into a whole bunch of detail here, I think one of the points that Neil made is really worth highlighting, which is what would have happened had this not gotten passed. The massive amount of tax increase really would have been detrimental to the American economy. And along with that, I think is what's important to understand is so much of OB3, which drives me nuts because it sounds like I'm talking about a Star Wars character, but so much of what came out of OB3 relates to the 2017 Tax Cuts and Jobs Act. And it's important to realize and remember how important that was for the U.S. economy. Prior to that, all U.S. companies were taxed at about a 35% tax rate. And when you look at our competitors, other countries that are in the OECD, from the year 2000 to the year 2017, the average tax rate outside the US that businesses were paying went from 28% down to about 20%. That left the US paying at a 35% rate versus our competitors, manufacturers that are producing outside the US but selling in the US, with a much lower tax rate, giving them a significant advantage for being able to make investments and to be able to do long-term planning. So the Tax Cuts and Jobs Act really brought American companies on par with, the competition that we're facing on a worldwide basis. And in passing that, due to a lot of different complexities, they did a couple of things. One of the problems was that some of the aspects of that bill were sunsetted. They were set to expire at the end of this year. And again, without this extension, a lot of the work and a lot of the benefits that we got out of the Tax Cuts and Jobs Act would have disappeared. The other things that they did and that Jim brought attention to is certain revenue raisers were included that really ended up having a significant detrimental effect on businesses. So what the OB3 did was providing a significant amount of support for businesses' growth. And this is really for large and small companies. It added to the R&D expensing. Companies can now immediately deduct their R&D costs, and they can take a tax deduction at the same time that the cash flow is leaving their business. Again, this puts us on par with the rest of the world. It's a distinct disadvantage when we were not able to, or American companies couldn't deduct their R&D, but others could. You're basically encouraging innovation elsewhere. Bonus depreciation, which was mentioned. Again, very important. The permanent business tax cuts. For corporations, the 21% tax rate was absolutely there. But that 21% tax rate did not apply to the pass-through entities, which are both large and small businesses, again, creating disparity that would not have been helpful. So OB3, again, leveled that playing field. Another element of OB3 was interest deductibility. Beginning in 2022, the tax code actually imposed a much more restrictive limitation to how companies could deduct interest expense, which was, the companies taking on the debt they needed to innovate, that they needed to grow, but their cost of doing so became much higher because of this rule. OB3 took us back to the older rules, which still restricts the ability to deduct interest in some cases, but it is much more flexible and far less punishing. Next slide, please. The other thing that it created was really the permanency of tax benefits to support U.S. IP ownership. One of the things that the Tax Cuts and Jobs Act did was to really encourage companies to own and invest in the US and to own that intellectual property here. The number of inversions, the number of companies that were based in the US and then decided to change and move their headquarters outside the US dropped dramatically after the US Tax Cuts and Jobs Act because of the incentives of wanting to own that IP here in the US and exploiting and using that IP. The Tax Cuts and Jobs Act, again, made it much easier for internationally operating businesses, as well as solely US operating businesses, to remain here and to be on par with their competition that is coming from all four corners of the world. So the next slide, what to do next with all the information that John and Neil and myself presented. I'd like to quickly summarize and say this stuff is complicated. As much as I would like to say it's simple, I've been doing tax for over 30 years. It still takes me a tough time to go through and understand it. So I'd encourage you to engage with experts. I'd encourage you to take a look at your financial models and really understand where you might be able to take advantage of these rules. I think one of the things that's going to be coming quick is updating your payroll systems. As John mentioned, there are changes for tips and overtime. While those aren't deductions for the companies, what you report to your employees does change. So making sure that your providers are ready for that is important. And then lastly, stay informed. Guidance is going to be coming out at a rapid pace, and it's really important to keep up with all the new interpretations as to how this law is going to be applied. And with that, I turn it back to Patrick.
Well, thank you. That was an enormous amount of information, and it really did provide uh, the real purpose of getting behind, but be below the headlines, and assessing the implications of what is a massively consequential bill, and making sure that for the business community, that you're prepared to take advantage of it, for the policymakers on the call to make your own judgment, get informed on the legislation, and also has some implications for our upcoming legislative session starting in January. Um, if there are any questions, please do put them in the chat. We just have a minute or two left. I did want to ask, maybe precisely with Geoff, if you could just explain the legislation that Maine was considering for a pass-through entity tax. And for those who are interested, would encourage you to contact your legislators. But could you try to explain the bill that's pending before the legislature, Geoff?
Sure, Patrick. That bill was very favorable to Maine companies because it was designed in a way that would allow pass-through entities to take a deduction for state and local tax purposes against their federal tax liability. At the same time, it would not have, because there was a credit mechanism included, that deduction for federal taxes would not have changed the state tax liability that you owed. So the advantage of it was that the state revenues would remain consistent, the state money that we need for bridges and all of those other things. But companies would have gotten a benefit against their federal taxes for that, or a reduction of their federal taxes. It's a complicated calculation that gets you there. It isn't particularly simple, but it's truly a win-win for the state where it supports Maine businesses without impacting, and in fact, may have increased state revenues.
It's important to note, I think a lot of uh, policymakers that ultimately did not support this change, including some in the administration, stated they wanted to assess where the federal bill landed at the federal tax level. And with this clarity, is there any reason not to pursue this, Geoff?
There really isn't. And this is something that's tried and true. As John had mentioned before, a number of states have passed this legislation. So we know that this legislation works. We know how the Maine revenue needs to implement it. And we also know that the tax environment is very dynamic. The beauty of this type of an approach is, as the federal government continues to change, or if there's adoptions or changes in interpretation, this rule still works.
Any concluding remarks, Jim, Neil, John, as we look to conclude our webinar? Thank you so much for joining us today. Jim?
I think Jeff's advice about taking advantage of these, learn these tax advantages for businesses, and make sure you understand them with your tax advisor. That was great advice.
John?
Yeah, and as a tax advisor, I appreciate those comments. And the best tax planning is proactive tax planning. And I know people are visual people, so if they want to see the mechanics of how the pass-through entity tax is designed to work, go through my slides. There's an example of it, and so you could see the benefits of how it could impact your business.
And Neil, any final comments?
No, I'll just say I think there's lots of opportunity here, both in terms of what your individual business is doing on the tax side, but understanding how this is going to affect your plans for investing in your business and investing in your employees. And so things that might not have made economic sense before may actually make economic sense thanks to these tax changes. And that's worth taking the moment and evaluating and reconsidering your plans.
Well, again, I want to note my appreciation for all of the panelists, all of those joining today. We will distribute the decks so people can dive into some of these details. But for the Maine State Chamber of Commerce, I'm Patrick Woodcock. Thank you all for joining our discussion today on the federal tax bill, the big, beautiful bill that has so many consequential elements for the Maine state's economy. Thank you all and have a great day.
Thank you.
Thank you.